Hello, and thank you for watching. This is Rene Ruiz with SoCal Purchase Loans, and today I'm doing a brief presentation on supplemental taxes. Now, the reason I'm doing the presentation now has to do with the fact that I'm getting a lot of phone calls regarding this topic. The first installment of property taxes is due by December 10th. That's actually the past due date where there's penalties after. And at the same time that that tax bill goes out, the county also sends out supplemental tax bills. If you're thinking of buying a home or if you recently bought a home, that means that you're either going to be affected or you're already being affected by this. So we wanted to put together some materials that would help you understand how this all works. So here's what I pulled directly from the LA County Tax Assessor's website. In addition to annual taxes, you may be responsible for paying supplemental property taxes. California state law requires the county assessor to reappraise property upon a change in ownership or new construction. The supplemental assessment reflects the difference between the new assessed value and the old prior assessed value. If the property is reassessed at a higher value than the old assessed value, a supplemental bill will be issued. If the property is reassessed at a lower value than the old assessed value, a refund will be issued. So the concept is that when you buy a home, you pay whatever the tax bill is set at. And if the previous homeowner was paying a lower amount because they bought the home years and years ago for a lower price, you're not going to inherit their tax basis. You're not going to be paying the same property taxes that they were. You're going to be reassessed based on what you're paying. And when escrow closes, the escrow company pays whatever outstanding tax bills are out there. Well, thing is, those outstanding tax bills are going to be prorated between you and the seller. But at the time that you become owner, you should be paying at whatever your rate is. Maybe it's higher, maybe it's lower. But that's why this calculation comes into play. The county eventually realizes that you became homeowner in the middle of the fiscal year, and then they backtrack and say, hey, we owe you money or you owe us money. Here's additional information. The taxes are prorated based on the number of months left in the fiscal year from the date of ownership change or the new construction completion date. If the change in ownership or new construction occurs between January 1st and May 31st, two supplemental tax bills will be issued. The first supplemental bill will be for the remainder of the fiscal year, and the second supplemental bill will be for the fiscal year that follows. Supplemental tax bills are mailed directly to the property owner and are your responsibility. In general, they are not paid out of your impound escrow account. A note on that. We actually like setting up your impounds to cover what we project your taxes will be. It is different from what other mortgage companies do. That's just how we prefer to do it. And quick note, obviously you saw that they mentioned construction. Where else does this apply? Let's say that you have a home and you've owned it for a while, and then you hire a contractor to build a ADU, or maybe you add a bedroom. When you do that, you're actually changing the value of the home. At that point, you could end up getting reassessed. So, things to remember. We, SoCal Purchase Loans, we like to set up your impounds based on the projected taxes after reassessment. So what we use is a standard formula. We use 1.25 of whatever, 1.25% of whatever the purchase price was. Some areas are a little bit less, 1.16, 1.20, but we are trying to be safe. Some lenders will use current taxes to set up impounds. That means that we're not doing it the same way everyone else is. By the way, we know that we're doing it differently. We choose to do it differently. It does require a little bit of extra work on our end and education too, because if you set up the taxes just based on whatever they are, and the homeowner basically moves in and they're not aware that the taxes are going to change in the future, they're not going to be happy. We think it's best to set them up correctly, but some companies, and I'm talking about mortgage servicing companies, will undo that work. Fact is, they're obligated by law to review and analyze escrow accounts once a year. Sometimes the mortgage companies that we set up our clients with will go in before the supplemental taxes are issued, see that there's too much money in the escrow account and refund it, and then our client has to backtrack to get everything fixed. Nonetheless, we think it's the best approach, and we've actually received feedback. People prefer getting the tax bill, calling us saying, hey, what is this? We give them the explanation, and then say, hey, good news, we put extra money in your escrow account so that you don't have to come out of pocket for that expense. Well, let us know what your opinion is on that, and please let us know if you have any questions. A special thank you today for veterans. I'm a few days late. This is November 16th. Nonetheless, Veterans Day was just a few days ago, and rather than thank you all for joining us today, I wanted to extend my gratitude to our veterans for their sacrifice. Thank you all for watching. If you know anyone that could benefit from this information, please feel free to share. And if you can think of any other topics that you'd like us to cover in one of these videos, please let us know. We would love to shoot that video for you. Thank you again for watching. Make it a great day.